Welcome back to my channel. In this video, I'm going to be covering Cigna, which is a healthcare payer company. You may be familiar with them. You may have your healthcare insurance with Cigna. This is a good company generating a high amount of free cash. And I've done some analysis on this company, and I'd like to share that with you. I'll also share with you my decision whether I'm going to buy this stock or not buy this stock. Do me a favor and like my video and subscribe to my channel. And also please leave a comment on Cigna. Let me know what you think of this company. Now, I follow a process when I evaluate a company, and I'm going to follow the process for Cigna. It involves first looking at the company, making sure that I really like the company, I like the industry, I like the management team. Do I like the balance sheet? Do I think the balance sheet is in good shape and debt has to be less than 3 times EBITDA? And am I getting a discount on the stock? I need to get a discount on the stock. I'm a value investor. I want to buy at a discount. And if I get the right answers, I will buy Cigna stock. Cigna is a health insurance company that covers many Americans for their health care. And they're also growing in providing healthcare services. So the company is going to provide pharmacy benefits and some care services to expand, not just being a healthcare payer, but also a healthcare services company. Overall, the insurance side of the company really generates a lot of free cash. And it's good that the company is growing into other sources for revenue. The company's growing, which is really good to see. Most of their growth comes from the business they've had for a long time, the insurance business. They're growing their pharmacy benefit services business. Their international business is also growing. They want to grow and especially grow fast in the new parts of the company, which is specialty pharmaceutical, care services, and they want to sell to the US government. Like any company, they want to be more efficient. Since they are bigger, they want to cut costs and generate more free cash flow. Looking at recent news, the biggest news was that the merger with Humana isn't going to happen. Stockholders really like that. The stock went up 15%. I think it was an acquisition or a merger that just didn't make a lot of sense, and both sides went their separate ways. So overall, I think that's a good thing. Sometimes getting bigger doesn't necessarily mean it's going to be better. And it looks like stockholders really appreciated that this did not happen. Cigna plans to generate a lot of cash. In fact, cash from operations over the next 5 years is expected to be $50 billion, which is a very good clip. And the business doesn't need all that cash to be put back into the business in the form of capital expenditures. So that's good. That means that there's going to be $40 billion of free cash flow left. The company plans to primarily buy shares of its own stock and then do strategic mergers and acquisitions. They'll also pay a dividend and repay debt. So very good to see that the company has a lot of cash coming up over the next 5 years. That should help them keep their balance sheet in really good health. And should there be a good acquisition, they'll have the cash to make that acquisition without driving up debt. So Cigna provided guidance for 2023 for the full year. Earnings per share is expected to be $24.75 per share. So I'll use that in my valuation. I'll also use the cash from operations that's expected, $10.5 billion, which is a very good rate of cash from operations, and use that less capital expenditures to determine free cash, which I'll use in my calculations. Cigna has a market cap of $87.6 billion. There's companies in their exact industry that are much larger. United Healthcare is much larger. So they're a smaller company, and I like that. Their forward PE ratio is nice and low at 10.6. I think that's an opportunity. If they really operate well, I could see that turning into a 16, and you can see the stock price really rise. The free cash flow they generate, if you look at the last 12 months, is $10.89 billion. That's just a very high level of cash. Consider that their market cap is only $87 billion, yet they generate more than 10% of that rate in free cash flow. So very good free cash flow rate. You can see that they're growing organically, growing their top line revenue. Earnings per share is also expanding, 13% growth in earnings per share. Very good to see. If you look at their forward multiple on PE, it's well below the industry average of 17. So I'm going to use a higher multiple to determine my value based on earnings per share, because I think they're going to trade closer to the 17 multiple going forward. I believe that Cigna is discounted by 84%, which is a very big discount. If you look at the cash flows this company generates, they're just very high cash flows. And that's where I get most of my valuation. And the earnings per share look good too. If we look at cash flows and then we'll look at earnings per share. Cash flows for the trailing 12 months are at a $10.89 billion. And if I grow those cash flows by a reasonable 7%, which is something they've been doing, and they've actually been doing better than that, I get all these cash flows from years 1 through 4. Terminal value is all cash flows beyond year 4, and I'm going to grow terminal value free cash flow by 3%. The discount rate I'm going to use is 8.5%. So it gets me a net present value of $205 billion of value in those free cash flows. I'm going to add the cash on the balance sheet, but take away the debt to get to an equity value of $183.8 billion. The market cap for the company is only $87.4 billion. So basically, each share is really worth $628, but stock's trading for $299. Overall, healthcare really was suppressed, pushed down. Stock prices were low in 2023. And this stock is really showing that it was kind of left behind. And I think the acquisition of Humana kind of put this one on hold for many investors. Overall, it calculates to be an 110% discount on the stock if we use the free cash flow valuation method. Now, there's two ways to look at it. There's looking at all the cash flows, but let's look at earnings per share as well. Earnings per share I'm going to use is $27.44 is the earnings per share that CNBC has. And that's the most conservative rate that I saw. So I'm going to use the most conservative one. I'm going to go with a higher PE of 17 because right now they're trading at less than 11 forward PE, but the industry is at 17. This is a healthy, growing company, very profitable, high cash flow generating. So they deserve a 17. I'm going to go with a 17. And I'm going to grow earnings per share by 5% over time. So my calculation of the value of the company based on earnings per share is that each share is worth $398, but shares are traded for $299. So it offers up a nice discount of 33%. So both methods show that the company is discounted, which is good to see. I like to put more weight in free cash flow method. That's 2/3 of the value. And then earnings per share is 1/3 of the value to get a blended discount of 84%. So should I buy shares of Cigna or not buy? Let's take a look. So first, do I like the company? Do I want to be a part owner? Do I like the industry? Do I like the management team? And the answer is yes. The company is a high quality company, good management team. The balance sheet's in really good shape, and it offers up a fantastic discount. So I'm going to be buying shares of Cigna and building a position in this company. Hey, thank you for watching the video. I hope you found it interesting. I'd love to hear what you think of Cigna. Please leave a comment on the company. Let me know what you think of this company. Also, do me a favor and like my video and subscribe to my channel. Happy New Year and best of luck investing in 2024.